Michael Davidov, welcome to Acquiring Minds.
Will, thanks for having me.
Michael, you started as a self-funded searcher, though you may not have called yourself that at the time. Since you've grown revenue 20x on that first acquisition and acquired platforms and other verticals. So this is a story of how buying a business blossomed into a substantial portfolio, dare I say, holdco. Let's hear the story, Michael. Take us back. Why did you turn your attention to buying a business in the first place?
Yeah, so I think, there was a couple pivotal moments for me that I think kind of put me on this path. So to rewind a little bit before I kind of went down this crazy world of acquisitions, I was working at a mid-market private equity fund. And, I think one day I was sitting across the desk from somebody who we had just written a fairly large check to. And I thought to myself, hey, I'd like to be, on the other side of the table, let's call it. And I thought, hey, at the time I hadn't operated anything. I'd done private equity and consulting. But in the back of my mind, I think that was kind of the seed that ultimately grew into, what we built today. And ultimately knew I needed to own something, buy something, operate something, but it had to be not mine, but, obviously we had investors, but, I had to be the driving force to really A, build something that I'd be proud of and B, get the outcome, that I was seeing on the other side of the table. So I think that's kind of where initially it started.
Michael, let me just stop you right there because you are not the first. There's a pattern. Multiple people who have sat in the seat you're now in have said the same to me, former private equity types who had that other side of the table moment, or who's really the smart one in the room here,
Yeah.
we private equity guys or the seller. So to be clear, you were basically stroking a check to a seller whose business you were buying. What kind of business was it? Was this a sort of typical blue collar tradesy business story?
Yeah, I mean, this was an individual who had started a franchise. He was a franchisee within a gym system, a large gym system that most people have heard of. And what really stood out was he was definitely smart, but he just went out and did it. Right. I think that's what really stood out to me is I think half the battle is just kind of having, the courage and maybe a little bit of the craziness to just go out and just go do it. And he'd built a great business and a great team and it was the right time for him. And I thought, hey, like if he can do it, like maybe I can get halfway there. So, and there was a couple different instances like that, but I remember that one in particular standing out to me.
I love it. The other side of the table moment. Great. We're making that a thing, Michael. Okay, carry on.
So I think from there, I decided to, I went to business school and that kind of gave me a little bit of opportunity to take a step back and evaluate, frankly, in a little bit of a risk-free way, what I wanted to do. And kind of start to scratch that itch that I think I kind of just mentioned. And, at the time, the search fund or entrepreneurship through acquisition focus was actually pretty popular. And so there was definitely a group and there was some professors that, were teaching it and there was an ecosystem starting to be built out. I can't say it was like the first one, but it was definitely, I think, a little less built out than it is today, which is, exciting. But
what year was this?
This would have been 2016.
Thank you.
So in 2016. And, started poking around and figuring out, hey, like, how am I going to be able to do this? This was while I was in school. And initially, I actually tried and had an idea, not to necessarily buy, but actually partner. I had an idea within the healthcare space, and I had done some healthcare work before. There was a doctor that I was friendly with that I knew who had an interesting normal practice, but an interesting little side business. And I thought, hey, like this might be an interesting way to kind of enter into this world. So I partnered with him while I was in school and said, hey, let's grow out. He had a side business that serviced nursing homes aside from his normal practice. And I thought, hey, like there might be a there. And it actually reminded me of a similar business that we invested in my old fund. I started to kind of build out a decent pipeline of deals, which started in healthcare, but then it kind of broadened out a little bit as you just start to meet people who, who sell businesses. And so at that point, decided to separate and actually kind of go full head first into acquiring a business. And given the background that I had in private equity, I thought a roll up would make sense. We always were, and when I say we, at that point, I actually decided to partner with my still existing partner and co-founder.
His name is
Jonathan, and he was also working on the buy side in New York, and kind of told him, hey, this is what I'm thinking about doing. And we'd always talked. Actually, we're friends from college, so we're actually really close friends from for a long time, but both had gone our own way professionally. And we thought, hey, let's go do this together. So we got together and started to actually bid on, some of these deals that were coming through. And we got very lucky. What I noticed within healthcare was, look, it was kind of a lot of the standard items that I think, people preach in this space, which is you want to look for fragmentation, which healthcare had, right? I would say healthcare today is still probably like the largest mom and pop business. There's quite a bit of, consolidation. There's no mom and pop hospitals, but there's still a lot of mom and pop areas within healthcare. And frankly, I think the other thing that got me excited, I'm probably not the first person to say this, and I know it's a little bit of like a meme, but when you walk into the office with a fax machine or, everything on paper and kind of very old school, this is definitely an area where you still saw a lot of that. So, I kind of walked into that and personally thought, hey, I think there's an opportunity to, go after some targets, make some process improvements, hopefully be able to build a better organization, and ultimately kind of do that repeatedly and build something of scale. And look, I will say also, personally, I also just enjoyed the fact that in healthcare, at the end of the day, you actually, if you're doing a good job, you're also hopefully doing some good and helping people, which, was nice. And a little bit of what drove kind of my thinking there. Great. So, so that's kind of where I'd say, and this was all still while I was, frankly, in business school. And so on the way out was when I had to kind of make that make or break decision where I was like, okay, are we going to continue down that path or try something, a little different, but in a similar vein. So
you have this kind of a loose thesis.
Yeah.
You bring it, you partner with Jonathan to join you on this.
Exactly.
And so what are the parameters or the search, the parameters of your target or of your search look for as you guys embark? Are I called you an unidentified self-funded search, or, you didn't maybe identify as a self-funded search, or maybe you did. Say more about that.
Yeah. So I think, I'd say that because I don't think I necessarily went down a defined path. I think it was a little bit just, kind of went with kind of how my path developed, which is I start with that story because we got pretty lucky in that a good deal came around pretty soon, actually. And I know, sometimes it can take a while. And part of that was, I guess, depends on when you start the clock, right? I guess if I started the clock from when I started the first partnership, it might have been actually 2 years, but it was while I was working on something, right? But happened to have some deal flow already coming throughout that whole period. And, when pretty much 6 months after I graduated, there was a deal that we closed on that came in through, actually, crazy enough, Biz by Sell, which came through there. And I think, look, the way that we were looking at it from a criteria perspective, I'd say, given we knew we wanted to do a roll up, we wanted to figure out just where are there robust amount of targets. That's the first thing, right? You don't need to life's hard enough. I don't need to make it harder to go find a needle in a haystack. So as we looked at industries, we thought, okay, where can we do a lot of acquisitions at, with a lot of speed? 2, we wanted to find places that had, a good revenue base and where we felt really comfortable with the stability of the business. And 3, I would say the last thing, which was a little more structure related, was we needed to find a deal where we could structure it where Jonathan and I could keep as much of the equity as possible, right? And in particular, I think our view was if we're going to start small, most of your dilution, and we kind of went at it not with a carry structure, but most of your dilution really comes early, right? When you're small and you're giving you're giving away a lot for $1 million as an example, versus later you may be larger and $1 million may not be much. So we were very, very cognizant of figuring out, like, essentially we knew we'd at the time going to use SBA because that was probably the only real financing available at, the smaller end back then. And so really what we were solving for was what's the most amount of EBITDA we could buy with the max SBA exposure and the least amount of equity, so that we could keep, the majority of the economics there. And still deliver obviously a great return to our investors, who, by the way, are still actually invested, the original ones. But that's kind of how we started.
That's great, Michael. And just say a little bit more about retaining the economics. This is kind of finance 101, but for some people it might be helpful. Max leverage means giving away the least equity possible, because why? Just take that the next 2 or 3 steps.
Sure. So max leverage meaning we wanted to use as much debt to finance the acquisition of the deal as possible versus equity. And what we then did, obviously it's kind of a little bit of a calculus, but what's nice about the SBA is, they view it from a percentage of purchase price essentially perspective, as well as a leverage perspective. But, given we were trying to buy stuff around initially in the, 3 to 5 times range, oftentimes you can max that out, which, is essentially like 90% on the SBA side, but you're not very levered from a EBITDA to debt perspective. You just have a lot of, it's a percentage of capitalization. So, that was what we tried to do.
Yeah. And for, again, those who may not realize this, that 90% leverage is really unheard of in larger, period. Outside of, it's a very unusual, those sort of economics or LTV is extreme. It's unheard of. And so that's one of the things, again, where the SBA is, in some sense, I don't want to say subsidizing, but it's enabling this market to occur, because take that away and no other lender is going to allow you to leverage so much.
No, that's totally correct. And I actually think the SBA product is really, it's pretty amazing for what it does in a lot of ways, which is it does enable, I think, kind of what its mission is, right? It is to some extent to allow people who maybe don't have a ton of liquid capital at any time to actually participate. And that's part of what it was doing. So, it's funny. Sometimes we'll talk to lenders. We used to talk to some lenders where, I used to say to them, I get it. Like, you don't want to go to 90%, but if I paid 3 turns more, you'd give me the same amount of money, but I just paid more for the business and you're actually only at 50% LTV.
That's funny.
But
that's an interesting point.
But it's the same amount of funding. But I get it. A more traditional lender wants to see more equity in the deal, and I would just kind of joke with them. I'm like, you're penalizing me for getting a good deal.
Okay, so got your parameters. So you kind of laid out 3. You wanted to maximize the SBA, and you wanted to high fragmentation, I think, and then the first criterion was what?
It was high fragmentation. It was also just, a good stable revenue source. So I think just the economic model, I think the way we looked at it was, we kind of look at everything through this lens, like, why does this exist? Like, how does this business deliver value? And, how stable is that value that it's delivering and its underlying economics? I think that's kind of the way we looked at it. And, I think what we were trying to really prevent against was, we wanted to have call it a good downside, if that makes initially, right? Like you didn't want something that could all of a sudden turn on us and go negative real fast with, 80% customer concentration, or, businesses that are project based and you got to go, rebid every 6 months, right? That kind of stuff is just a little tougher. And so we were just looking for businesses that we felt, could sustain for a while, with their existing customer base, or just as is.
Yeah.
So, which I'm sure
high quality of revenue.
High quality of revenue, right? I think that's the area that we were really focused on.
Great. And so with those criteria, was that just the kind of overlay for every deal you looked at, or did that then lead you to a particular industry that you were going to target?
I would say that was the overlay we had on pretty much everything we looked at.
Okay.
Look, we leaned a bit more towards where I'd say Jonathan and I had some historical experience in, right? I don't think So healthcare being one, industrials and business services were kind of the areas we'd worked in previously. And so not to say we didn't look at some other industries, but I think we definitely had some areas within there, that we really liked. I remember we obviously never bought anything in the space, but I really liked the pest control space back in the day, which I thought was a really good one. I can't say, that came from, we bought a business in my old fund that actually supplied all the like chemicals that they use to kill the bugs. And, I was exposed to that space and I was like, oh, actually that's actually, downstream. I was like, that's actually a pretty good business. So I think a lot of it came from, some of it was kind of ideation, but honestly, some of the better ideas I think just came from, frankly, everyday kind of life, just looking around and be like, oh, that's actually kind of interesting. And I get why they exist. And funny enough, sometimes I even think about kind of my personal life, right? Like I think, depending on where you are, but I don't think I'm canceling my pest control services anytime soon, right? If you want to use that as the example.
Great. So what'd you find?
So what we ultimately found was our first acquisition, which was a business at the time called American United Home Care, which was a home health business. But interestingly enough, a little bit different than I think your traditional home health. I think most people, when you think home health, you think, nurses going into somebody's house, tends to be older, so geriatric clients. This was actually a pediatric and young adult focused home health. So what they did was they took care of individuals who had high physical acuities. So this might be somebody who may be on a breathing tube or have a vent. And what they really did was they enabled these a lot of times kids or again like young adults to live independently in the community at home with their families and allow them to actually like thrive and allow their families to thrive too. Because without the support, frankly, the family would either be pretty much focused 24/7 on taking care of them, or in some cases would actually most of the time have to be institutionalized. Which is tough. But I think on the flip side of that, what they did was amazing work, and you allowed these these individuals to really grow and live full lives. I remember there was one client of ours who graduated from law school, which was awesome. I remember we got a picture and he was there, and without, and by the way, like without us, I don't know if that would have necessarily, we were a small part. It was all him, but I think it was a nice feeling. But when we evaluated it from a business perspective, first of all, we loved the space, which was, when you talk about kind of evaluating the revenue, which is where I'll start, right? You have no customer concentration from a true perspective. If you're talking about each individual client or patient, you had a couple hundred, right, that you were taking care of. Additionally, you have, you do have an insurance element here, which in healthcare is it's kind of its own thing, but you have a pretty high credit customer in terms of who's paying you, right? In this case, it's a little interesting because the person you're delivering services to actually isn't the end payer, the insurance is, but nonetheless, they are a good credit and pay on time and pay pretty quickly, which we liked. And I think, third, I would layer on that value prop that we always look at it from. And I think, the way we looked at it was these are individuals who require care. Okay. And first of all, not only they require it, in my opinion, they deserve it. But secondly, the way we had seen that they also oftentimes, when you think about kind of how a payer thinks about it, an insurance payer, right? Like, yes, they want to do what's right, but they also have to look at, well, what's the economics of this? And the alternative, like I mentioned, would be in many cases institutionalization, which was, I think we'd seen some studies like 6 times the cost of what we were providing. When I say we at this point, we did acquire it. And, what we viewed it as, we thought it was a win-win, right? You're able to provide a cost-effective, preferred setting level of service for, individuals who, deserve this, this care. And so we dove right in, and, in essentially Jan 1 of 2019 was the date pretty much, we acquired that agency, which at the time was doing about $6 million in revenue.
$6 million in revenue. And so these are agencies. So home care services are essentially agencies. I mean, they're in some sense they're staffing businesses, right? You're finding nurses or nurse adjacent people to help the patients. So you're bringing them in the door, and then you're dispatching them to the homes of the patients, and that's kind of the business. And then kind of growing that flywheel. We can hear a little bit more about that if helpful. And great. And so, what do margins in a business like this look like?
It can vary a little bit. It's obviously the biggest thing is just kind of what your different insurance payers pay you versus what your labor costs are. But look, I think what you try to typically target is, gross margins in the probably like high 30s ish is what you're trying to target. Depends on kind of where that is. And then, your EBITDA margins at the bottom line they can vary just depending on how much support staff is needed by the client. So, but you're probably somewhere in the, mid like you're in the teens if you're operating effectively.
Great. Okay. So this is a $1 million SDE business.
Yes. And it was definitely SDE because there was, the owner was very much so doing a lot of the work.
Tell us more about what is the human capital in a business of that size and an agency in this industry look like?
Yeah, I mean, so you're, starting kind of at the top. You obviously have your nurses. That's kind of your front line, right? So you have a pool of, not even a pool, you have a whole team of nurses who are on the ground every day providing services to these individuals. And actually, one thing I forgot to mention is like the individuals you work with are actually pretty long duration. So you have nurses who are paired up with these individuals for a very long time. So you actually have a pretty, it's a very they have a strong bond there too between them two. So you
long time meaning years.
In a lot of cases years. Yeah. And so that's kind of that's really your core, right? I mean, in some ways when we came into the business, we always viewed our frontline staff, frankly, almost as like a different set of customers, right? Mm-hmm. Like I think in any business, by the way, you should view your employees not as employees, but kind of what can you do best to help them really do their job in the best way, and also make it the best place for them to work, right? Yeah. I mean, because without them, I mean, frankly, we wouldn't have had a business, right? So I think that's kind of what we woke up every day thinking about. But to kind of continue on your question, after kind of your frontline staff, the next thing we really had was kind of two groups of individuals. We have some supervisory nurses that are kind of higher level nurses that were there to make sure that if any of our frontline nurses needed support, or if any of our patients had any conditions that were worsening or needed real attention, that they could provide that support. And then behind them, you'd have your schedulers and your recruiters, because to your point, a big part of this business is ensuring you're recruiting, top-notch nursing talent to provide our services that we do. And then what you then also have is kind of the back office function. So you have your billing function and HR and and some of your just general administrative. So that was kind of what we walked into. But at the time when we walked in, I think the team was the non-frontline team was 7 people.
Yeah, 7 people. So this is right. So this is a pretty small business, although for a $6 million revenue, $1 million SDE business, you probably did come close to maxing out that SBA loan.
We used every dollar.
Used every dollar. Your point about thinking about your frontline caregivers and nurses as your customers and not just employees. The other person I've heard say that was also in a home care business, another guest, probably 200 episodes ago now, Jerome, in a Visiting Angels franchisee, bought 2 locations, 2 territories in North Carolina. And he found it was a very difficult business for him to get his arms around. But when he had that sort of epiphany to think about his caregivers as his second set of customers, it just sort of changed everything. And it really was sort of an unlock in terms of how he thought about the business for him. So very interesting that I don't know if this is unique to home care or just staffing in general, but thinking about your employees as customers, interesting. Because we know where this story ends and how big you've grown, tell us to what degree, if any, you were thinking long-term or big picture. Did you have a plan to grow to over $100 million in revenue? What did you think that was going to be year 5 and year 10 in this project was going to look like?
Look, I think we definitely had a goal to get larger. I don't know if we necessarily put like a bogey of 100 million plus, but I think yes, we got into this strategy with a goal to grow really quickly and try and do and get big.
Yeah.
I think, and that kind of, I would say, directed our strategy a little bit right from the beginning, which was, we really spent the first year, call it, creating what we tried. And by the way, we, as in Jonathan and myself, we operated for the first couple of years, this business. And I think kind of our strategy was, hey, like, let's just understand all the nuances of this industry, of this business that we had just bought. And let's just try and create the best, individual, existing unit we can, right? Like, let's try and put in the best systems, the best people, the best processes, because I think, if you're going to try and then go do a bunch of add-ons and integrate, you need to have a solid base and frankly, a good framework on which to then put all those add-ons onto. So, I think we spent probably the first year really doing that. It was a pretty heavy lift, that I was maybe expected, but maybe not as much as I had initially thought, but we were able to do that. And then from there, we kind of geared up and started really driving deal flow, which is interesting. I think once you buy something and you're in the space, a lot of people actually start start knocking, or frankly, will just pick up your call more so than, I think I'd done let's just call and email a bunch of people in a space pre-acquisition, right? And I know it's worked for some, but frankly, it wasn't super effective on our end. But I think what was interesting was it did work kind of after we were in the space, and not that we were known by any means, but somebody Googled and saw, they're like, oh, okay, like this person's actually, run something similar, and I think it kind of gave the comfort actually to additional people. So yeah, we've kind of gone a little away from your original question, which was, did we look to go big? But the short answer is, yeah, I think we did, and it was part of the kind of initial strategy for sure.
Let me react a few things there. First of all, we call this the value of getting in the game, Michael. It comes up again and again and again. And I'm always so enthusiastic for people to get in the game, while balancing, not everybody should just go out and buy the first business. There are perils there, which we spend countless hours on this podcast talking about. But at the same time, there is just so much acceleration once you're actually, you've done your first deal and you're in the industry and you're an owner operator and other people see you as such. So thank you for sharing your own experience with that. I love it. It's sort of obvious that you to do a consolidation play, a good way to spend the first year or two is to be very in the business as operators and to learn every corner of how to operate one of these businesses, the industry, just get as close as you can. But probably for some, it's a little counterintuitive, or it's a little, their impatience wouldn't let them do that, because if you want to build something big, it's all about working on the business, and it's about, inorganic growth and finding that next deal. So I guess it's obvious, but kudos to you guys for having the self-discipline to say, yeah, we want to get big, but we got to go slow to go fast, sort of thing. Anything more to say about that? Because it was such a good decision on your part. It's, again, kind of obvious, but I feel like it might have been tempting to not do that. It might have been tempting to just go out and find your next deal, especially to your earlier point. All these deals are coming to you now that you're in the industry.
Yeah, I mean, look, I think weirdly enough, I actually think it probably sped up our time horizon, in the sense that I think one thing that could probably doom you is like a bad deal, and not necessarily a bad deal even from like a structuring or financing perspective, but if you're just not ready to take that on, which frankly, we weren't in the first year. And I think if you hire for the growth, if you set it up for the growth, you actually will end up running faster afterwards than you would have let's say if we missed out on 1 or 2 that first year, right? I think we probably have done more now we've been in it for about 6 than we would have if we would have done those first 2, right? Because we would have been just so bogged down initially.
Yeah.
And probably never put the right stuff in place, right? It maybe would be the other thing too.
So let's explore like what were some of the levers you pulled, systems you put in place, fax machines you got rid of that basically made your platform, this is essentially a platform acquisition, stronger so that you could then acquire faster. What are some of the best practices there reflecting back?
Yeah. So, I mean, I think it's helpful to explain a little bit of the organization we walked into, which was, they were doing everything still pretty much on pen and paper. I actually remember when I walked in there, like the first week, we were hiring a new nurse, and I asked the person who was in charge of kind of getting the new hire paperwork to the individual who came into the office, getting the paperwork. I saw her standing at the copy machine, and I noticed that she was actually copying a photocopy of the new hire application, and they actually didn't even have it like the original on a computer, just to hit print a couple times. So we felt like there was just a lot of basic stuff initially to do, and really what we tried to execute on was, look, we wanted to just go digital first on everything we could, right? So the first thing we kind of instituted was actually on the HR and hiring front, right? That's really the core like back office function of this business, and it's pretty competitive. So what we tried to really focus on initially was, how do we make hiring as easy as possible, right? I don't want to ever because it used to be like a 2-week process when we got there, and you can imagine if somebody down the street is offering this nurse employment, can get them working tomorrow, right? Like we're not all that competitive if we're saying, oh yeah, we might be able to finish your paperwork in 2 weeks. So that was one of the first
thinking
areas.
about nurses as customers again.
Yeah, exactly. We were like, I think the way that we always thought about it was, I wanted somebody to be able to get their paperwork done, sitting on the couch at home if needed, right? Like there's no reason nowadays that I need you to come in to necessarily, put in your name and all that information. And so that was really like the first thing that we really tried value lever to pull was, let's just improve our time to hire, and let's just make that process like super seamless and easy. And so that was the first thing we did was, we picked a good HRIS and payroll system and kind of put in the appropriate processes. And then after that,
and did you see results that like, speed from nurse raising her hand to actually being in the field, that throughput resulted in more revenue?
For sure. Yeah. We were able to hire immediately. There was less drop off. So we used to track kind of, from like a inbound interview or just initial contact to actual start and hire. And at that point, it became fast enough where the holdup wasn't us. The holdup at that point was actually just the nurse themselves needed to finish the paperwork, for example. But no, it sped it up, and we were able to hire much faster and get people working, frankly, like within days of them contacting us, which definitely helped. And so, that translates to more revenue, and it grew and helped grow the business quite a bit.
Yeah.
So that was kind of one area we really focused on. The other area was actually getting just the general practice overall electronics. So, practice management software exists out there. It's kind of what most healthcare businesses run on. Think about it like an ERP or CRM, some kind of mix of those two things. And what that allowed us to do was kind of schedule and document everything digitally, which right now was being done very manually. Like we're talking, paper charting notes that had to be emailed, or not even emailed, had to be mailed or dropped off. Well, when you're in healthcare, you're not allowed to, there's HIPAA, so there's certain so there's certain things you can and can't do. So we would have people come by the office and just drop off reams of clinical notes and stuff like that, which was just very inefficient. And frankly, again, talking about our nurses, like it was time out of their day that they had to drive there, and gas that they had to spend money on to go drop off their notes. So we were immediately trying to focus on getting that pretty clean. And I think the other piece that we also tried to do was, once we had good data, we were able to actually offer and clean digital data, we were able actually to offer some benefits that we weren't even able to do before. So we moved to like weekly payroll, which was a big deal and really helped our employee base, which just from a processing perspective, we would never have been able to do, the way the business was before. So, we were able to improve our employee experience, our existing employee experience, improve the onboarding process. And also as part of this, frankly, like, let's not forget about our clients, which was we were giving our clients and their families, full digital access to their records and to calendars, and just delivering, frankly, just a better overall product and experience. So, that was kind of our first move from like a systems perspective. And look, I don't want to underestimate also how important it was also just to hire up the right people, right? So bringing on, I remember we brought on kind of like it was like a director of operations to help manage some of the recruiters and the schedulers, which kind of that layer hadn't existed. And also just frankly get more recruiters, invest in more recruiters and more schedulers to provide, to do more outreach, and also to frankly provide better customer service and reach out to our clients and ask them how they're doing and how their nurse is performing and all that kind of stuff. So that was really just the basics of what we did initially.
Michael, I actually feel like a lot of this was working on the business. You're not doing the blocking and tackling. You're putting in systems, not to take away from the value you were adding. But is that fair to say that you guys got in there and just started, these are all big strategic improvements?
Oh yeah. We kind of tore everything. We looked at everything from zero, and we thought, hey, like this function, how can it be better?
Yeah.
This function, how can we kind of, and let's paint what we tried to do is just paint a picture of what's ideal. And look, we kind of built the roadmap out from how do we get from where we are to there, with obviously some intermediate steps, right? You couldn't get to the end, all at once, but no, we definitely looked at every single function and every single stakeholder and just thought like, how do we actually make this better for them?
But for example, you brought in an operations person, so you were not operating the business.
I mean, we were overseeing them as CEO, right? I'm just saying we brought in, I would say, more of a middle layer, but what had existed before was really just, let's call it the owner and then just, office staff, right? Yeah. And I think what we started to do, part of that was to free us up from some of the day-to-day to be able to do some of these bigger changes. But I would say the other thing was, we knew we were going to eventually have, a recruiting staff or a scheduling staff that would be, 10 or 20 or 30 people. And at that point you do need, mid-level managers over that, right? So we were also trying to hire maybe a little bit in advance of the growth we were hoping we'd see. So both organic and inorganic.
Yeah. Just on the numbers a little bit, again, loosely calling this $1 million SDE business, you then put an SBA loan on it to buy it. And so half of your SDE is now EBITDA is eaten up by that loan. That leaves you $500,000. You guys both are coming from, you could have had other jobs on Wall Street. By the way, you moved from New York to California. We haven't said this part. This business is in LA, where you're both from, happily, right?
Yeah. Actually, so Jonathan, my partner, was the one who was in New York. I moved back after business school to LA. But yes, we're both from Los Angeles, and we're fortunate enough that this business was based in Los Angeles too. And
you were already back there. Okay.
Yeah, and so we were able, but he was able to come back as well, and kind of when we close on this and join up. Great.
So back to the numbers, and really what I'm getting at here for your benefit and the audience is to kind of like show what it looks like to be reinvesting heavily into a business to make it a strong platform and foundation using an SBA structure. So you got $500,000 left over after your SBA loan payments. You got to pay both of you guys. Maybe you can share to what degree you were paying yourselves, probably under market. And then you're making all these investments that you've just shared with us. So heavy J-curve kind of investment here. Can you say more? What did the numbers look like? Where you basically kind of probably took the business to no profitability in this first couple of years?
Yeah, there was a mix. So look, one of the theses we've had in healthcare is some of the areas we like to invest in are areas where the reimbursement cycle may be at its bottom. And what I mean by that is, in healthcare, oftentimes you don't get price changes very often. You might get them every couple of years. And so we kind of had we knew that this business and this segment was probably due for a little bit of a bump on a rate increase perspective. And so part of our initial investment thesis was if we were buying what we were buying, but we kind of were pricing in what we thought would be a bump within the next, call it 12 to 18 months. And so we did get, fortunate enough that there was a bump in the rates. And so the business effectively grew, pretty significantly, just from a pricing perspective, pretty quickly after we closed, which helped give us a little bit more of a buffer. So, that was kind of part of the thesis that we had, which kind of proved out. So it gave us a little more room. That said, we were still definitely paid way under market because we were not taking really any money, regardless of how that was going.
You weren't really paying yourselves.
I mean, very, very little.
Nominally. Mm-hmm.
Yeah, very, very little. And, I think to your point, I think what we tried to do though was, I think sometimes out of necessity, right? Like, and actually part of the culture at the company I think still exists, which was, frankly, we weren't cheap, but we were frugal, if that makes sense, right? So like we invested in the areas where we really thought there was value, but in areas where frankly it was kind of superfluous, like we really tried to, cut back, and we tried to also just use the right processes to frankly kind of lessen or increase the amount of work or the amount of flow through that any individual could potentially do. So, I think what we did was, yes, we invested quite a bit and we took our EBITDA down a little, but most of our investment was kind of on a variable basis, right? Like this isn't we weren't buying a large piece of equipment or anything like that. And so most of our investments we'd expect, frankly, some type of payback pretty quickly, right? If we're bringing on a new recruiter, for example, from like a human capital perspective, I mean, that person should be bringing on nurses immediately, right? And
great point.
In this business, there's frankly no lack of demand for services. It's actually more of a supply issue, generally. So it's one of those types of things where if, a recruiter can very much justify themselves very quickly.
Yeah.
And even the software that we, tried to implement, there's definitely a cost there, but, the savings versus frankly being on paper were net almost like neutral. So we did invest, but I'd say we tried to invest in areas where the ROI was either high or just pretty immediate so that we wouldn't have to, run too close to the sun.
Yeah. Love investments like that. More of those, please. Quick and very visible ROI. Best kind. You just said these types of investments, they were also kind of incremental investments, maybe hiring a recruiter, that's more of a big outlay. But again, they kind of start paying for themselves. They kind of become a profit center, kind of like hiring a salesperson quickly, you hope. One of the things that you'd kind of mentioned in passing in our pre-call was being in a people-centric business, which is what this is, as opposed to a heavy CapEx business, let's say. Say more about maybe the pros there, but also the cons of being in a business where it's really all about its services. You're selling services.
Yeah. So look, I think the pros are you can kind of grow in almost an unlimited amount, right? Without having to actually, put a huge capital outlay. If ultimately what generates revenue in this business, right, is hiring that next nurse, and there's a little bit of training and onboarding, but they're, let's call it, generating revenue very quickly, right? You're not really taking a loss on that growth initially, right? There's not a whole lot of what I call like investment. And so I think that's definitely one of the positives of this business is you could kind of grow forever without having to necessarily, invest in the other side of that coin, which is, let's talk about a factory, right? Eventually you might hit a capacity issue and you'll have to either build a new factory or buy a new machine or whatever it might be. And there you actually have to think about, hey, how do I actually finance my next round of growth? So I think that's kind of, the way that I look at it. On the flip side though, on, the stuff that's a little more capital heavy, you're able to, once you kind of invest in it, you're actually able to, get a little bit more marginal dollars out of it, right? On the flip side, I don't have really the ability to get like economies of scale on people, right? Like you're just your capacity constrained. Each person, you just have to hire another person if you grow.
Yeah.
Whereas a factory, to some extent, right, you can initially it's a big capital outlay, and the cost per widget or whatever's coming out of there. But I think there's a nice kind of you're able to get some economies of scale from that as well. So there's kind of puts and takes. And I think the other thing too is, frankly, it's harder to enter a business like that, right? If there's real capital commitments needed, it's a little bit, the barrier to entry might be a little harder than a staffing business, which frankly, you kind of can, if you have some know-how and some grit, you can kind of do it, right? You can kind of go out there without a whole lot of cash and start one up.
Right. Which of course, barriers to entry works both ways. If you're on the outside looking in, low barriers to entry is a good thing because you can get in the game and start competing and be in the industry. On the inside looking out, it's not a good thing because all these other competitors can flock in.
Exactly.
So do you find in your low barrier to entry business that it is cutthroat? It is super competitive?
So it is very competitive from a recruiting perspective. The one thing that I will say that we did like about healthcare generally in this sector is there may not be, once you're in it, it's pretty competitive, but there are some barriers to entry that are, let's just call it a little non-economic, which is there's definitely a regulatory and licensing component within this space, which you can't just, for example, tomorrow go open up a home health, and you actually need to go through a whole kind of process to do so. And so, once you're kind of in, it's actually very competitive, but to actually get in, it's not impossible, but it definitely takes some time. So there were some barriers to entry in this service business, versus maybe some others where there's probably just, there isn't much, right?
Yeah. Yeah. And all of what you described about the business being totally, what's the opposite of digital? Whatever, manual, analog. Thank you. The analog. Thank you. The business being completely analog. This was 2017, 2018 timeframe?
2019.
2019. Okay. So only 6 years later. Do you think that these opportunities still exist, or do you think most like agencies at this point have digitized?
I think some do, but I think the industry in just general has moved forward quite a bit, actually.
Okay.
But I still think there's some people out there who, I get it. They've worked the way they worked for 25 years and it's gone really well. And, why change it? Like, by the way, I'm probably going to be that in 20 years myself, but maybe at some point. But
well, right. And we're not disparaging. I don't ask to disparage those folks, but more to speak to the audience about whether opportunities like you found still might exist or they have been picked over.
I think there still exist, but I think it's less, actually.
Yeah. Great. And we're about to move on just from this first year or two, but you did have a payroll story. So tell that to the audience, please.
Yeah. So, everybody I talked to in the kind of this ecosystem, the acquisition ecosystem, was always, I remember the first thing they always said was, after you do a deal and it's your first time on the ground, don't mess up payroll, right? That's kind of, I think, the top thing everyone talks about, because the new guy comes in or gal comes in, and the thing that obviously people care about the most and want to make sure that doesn't change is their paycheck, which, by the way, I get.
Right.
And so with that on my mind, I remember we were making the transition, and we'd set up everything with ADP and we were ready to go, and that day came where we were going to hit go on that first payroll. And we got a message back saying that it didn't go through. And we look at the bank account, it has cash, more than enough to cover. And we kind of fret, and we're sitting there, it's Wednesday evening, Friday's payroll. And next thing I know, we called the bank, and what we didn't realize was, so we did an asset deal. So we had a new bank account, and versus so we didn't actually keep. We had access, but we were tying it to a new bank account. And I guess they weren't used to, on a new bank account, that amount of money being withdrawn from the account. So the actual account didn't have the approval rights to draw the amount for payroll, even though the cash was there, because it was relatively new. And there was nothing we could do at this point to make payroll actually hit on time until the next day. But if we would have waited till the next day, stuff wouldn't have cleared until like Monday. And so with all this in the back of my mind, everything everybody had said, I was like, okay, like what do we do? And actually, we had the idea, which was a little old school, but worked, which was we sat there with the actual physical checkbook. We went through the entire check statement for, I want to say it was 140, about 140 employees at that point. Went through and we wrote every check by hand. I remember we were at my apartment, me, my wife, and my business partner, and we sat there and just wrote each check by hand individually, and then spent all day Thursday and Friday going to a branch of each type of bank. So you have to go to Chase, you got to go to Bank of America, every single one, and we literally direct deposited every check into everybody's bank account, so that everybody would get paid on time. In fact, actually, some people called and they were like, "Why did mine come in on Thursday?" And we said, we didn't tell them why, but we're like, "Oh, that's weird. It must be the new system." But nonetheless, we were able to get everybody their check, even the one person who had a credit union that only had one branch. I think that was like 3 hours away, but nonetheless, we were able to get it done.
Wow. Well, way to pull it off. That's one of those really kind of year one stories. Good. Okay, Michael. So after pulling these levers, after working, you making this first acquisition, a real foundation, a real platform, take us through, the next part of the story, or maybe even fast forward through a few years, because what you got now is a lot bigger, and I'm looking at the clock, and we're only year one into acquisition one.
I know. Okay. I'll speed it up a little bit. So what we ended up doing in year two was a little crazy, because there's that little thing called COVID that happened, if everybody remembers. But we nonetheless kind of kept going at it, and we thought our thesis makes sense. And frankly, I would say we weren't a COVID winner. We weren't really a COVID loser either. It was kind of actually pretty steady throughout, given I think kind of the nature of our services. But
although that does tell you that the quality of revenue is incredibly robust, that your revenue just stayed all the way through this international crisis.
Yes. I mean, I think that shows kind of just how needed, frankly, it is, right? I mean, it was one of those things that, was never going to get, shut down. And so, we continued to work, but we went into acquisition mode after that. So, we'd grown the business nicely. We'd gotten that rate bump, which helped quite a bit too. And at that point, we found another similar, type agency based in another part of Southern California, but not in an area we currently had any services in, to acquire. And we acquired that business. We used, at that point, we refinanced our SBA debt. We were able to have enough EBITDA with our existing business plus the add-on to, at that point, work with like a small bank to actually write us a different type of loan, and kind of did that one all debt. And then kept going and actually...
wait, sorry. Did that one all debt? What was it, an SBA loan? No.
It was not. No, it was not an SBA loan. So at that point, it would have been too much. Would have been too much to do with
past
the
SBA. Past the 5 million.
Past the 5, correct.
But what you just described there, where acquisition number 2 in the same NAICS code, even with the SBA, you can acquire without putting any money down. The lender can do 100% of the deal, do the whole deal. Even within, if you could continue using that SBA 5 million, you guys would have maxed out the 5 million. So you did conventional, but had the same effect. And of course,
correct.
This is an incredible accelerant that you don't even need to bring any equity to acquisition number 2, all financed by a loan.
Yeah. So we did that. And then, which was definitely super helpful. And then actually part of that was there was a program during COVID that actually allowed banks to extend additional credit, actually, that a bank tapped into, that allowed us to actually then do a third deal, similarly all debt as well. And with, we continued to grow though. So the leverage profile actually was delevering as we kind of did some of these, not a crazy amount, but a little bit. And so a couple months afterwards, we closed our third one, which is in a different part of Southern California as well. And at that point, also at the same time, we opened up organically a couple different offices in Ventura County and San Diego. And so we kind of really now we're really in year 2.5. We really pushed it pretty hard, right? We did, we did the 2 acquisitions, we opened up a bunch of offices, and at that point, kind of we're sitting on a pretty nice size home health business with good coverage across almost all of Southern California. So we did that. And then,
Michael, wait, nice size after let's call it the end of year 2. What does nice size mean?
We were probably somewhere between we were probably in the high teens. So almost 20 at that point was kind of where we were at.
From a base of 6. So you tripled the business essentially in over 2 years through both organic and inorganic. And so this kind of acceleration, this is because as you grow the business, you're feeling confident that all of the strengthening you've done to your platform was working. That the hiring process, for example, where you could get a nurse, working super quick, and the recruiters that you'd hire, all of that kind of synergistic stuff was working as you plugged in and grew.
Exactly. So that kept working. And, I think one of the things that was nice was as our EBITDA grew, right, we were able to kind of use that new EBITDA to relever a bit. And the, lending partner we were working with was super accommodating and allowed us to do that. Again, our leverage profile wasn't very high from an EBITDA to debt perspective, and they kind of let us continue to keep going without having to put additional, we put a little bit of equity, but it was just cash off the balance sheet, frankly, which was kind of a little bit, a little bit near neither here nor there. There was a little bit of top up that they wanted to see, as opposed to, maybe making a distribution to ourselves. But we were obviously wanted to be good partners to them as well. So they helped us quite a bit in doing that. And then, I think what then happened was a little interesting was we had actually been working with we had an intern who was another, I think maybe, thought he wanted to maybe buy a business as well. He was Anderson MBA, and he had been working for us for a while, and he was interested in the in-home ABA, so autism therapy space. And, we'd been working with him, and actually during his time with us, we found a deal that came across our desk that we liked, and we decided to work with him. And we ended up using the SBA loan that we had at that point paid off, right? So we actually took out a new one and bought a SBA, and we used the SBA again to buy an ABA business in home. And part of that was, look, we actually thought it was a really interesting space, a lot of the same dynamics that we had in our pediatric home health business. There were also some synergies across both that we thought at some point maybe it would make sense, but initially, kind of would acquired it as a separate a business. We did do some shared services, which was nice because that one was smaller at the time. So that one was able to benefit from some of the administrative back end from our existing pediatric home health business. But that was kind of the next step in kind of the evolution of our business and holdco. I think, we always wanted to do a roll up, but we were also always interested in potentially venturing out into a couple different holdings from the beginning. So you considering that a entry into a new category? That's what you consider that ABA business? Yeah, it was. It's tangentially related, but it was definitely a new category. But a lot of the same dynamics, right? If you think about kind of what we're doing, and that's kind of what attracted us to it, which was you're recruiting, skilled professionals, you are managing schedules, you're sending them to somebody's home, you're providing good quality care. And again, I think, like at the forefront of everything we did was trying to provide the best experience for our clients, the end patient, as well as our frontline staff. So it was kind of the same ethos. And so, we went into that one, and it was definitely helpful to have a on the ground operator there in terms of just capacity, because we were still operating the home health business. And so from there, we then, after that, we continued to just grow and acquire in both of those segments. So we did another home health acquisition again in Southern California, which added, kind of our fourth deal in that segment. And we did an add-on to the ABA business as well in that third year. So at this point, after 3 years, we were sitting on 4 acquisitions in the home health side and 2 in the ABA side. And so that takes us kind of all the way through 22-ish, right? So we were kind of sitting there, and we had at that point we had started to invest in some real, like additional mid-layer management and some higher level talent too.
Going back to the acquisition of the ABA business, you mentioned that there was sort of somebody you were working with already who could have been a searcher, maybe eventually wanted to be a searcher. Did you put them in that business to lead that business? That was the point there?
Correct. Yeah, they were they ended up being kind of the lead on that business, correct.
And did they take equity in the business as well?
Yeah, we gave them, they took equity, invested, and also we gave them like a plan that he would be able to earn some additional equity, similar to how a CEO or some COO, type would be able to earn it. Correct.
And is there a model there? Because there are a lot of people listening who are looking for a way to maybe not just go pure, self-funded themselves on their own, nobody around them. Either to de-risk or to be around people who've done it before, who are further along the journey, like you guys. Is there a model there that others can emulate? I mean, it's two sides. There's the searchers, and then there's the the people who would kind of partner and bring a lot of the capital, the infrastructure to it. What can you say about how you guys worked that out and how others might emulate it?
Yeah, look, I definitely think there is a model that worked out well in our case. I think though, both sides have to bring a good amount of value though, right? And I think what we were able to provide, him was essentially a plug and play, ready to go deal, right? I think a part of the calculus of a searcher, right, is the uncertainty, not just of closing it all, but then even if you do, of just the time, right? A year or two is worth quite a bit. And so, I think it was the right opportunity. It was the space that he and we were interested in. And because of the work that we'd been doing together, we had a deal ready to go. And I actually think it wasn't by design, but I actually think we closed like a month after he graduated, right? So it was just kind of a perfect situation. So I don't know if it was necessarily, it wasn't some intentional program we were running, right? It just happened, I think, to be a little bit of fortuitous alignment.
Okay. So hard to re-engineer maybe.
I think without like really being, and I think some people are trying to do it. And I think it's great, by the way. Like I think there's actually, for individuals who have like created good deal flow and have a model and are able to do deals. Like I think right on the one hand, you have a lack of operators too.
Exactly.
Right? And so I think, I don't know how it gets done in like a more structured way, but if somebody can figure that out, I mean, I think there is a there, in my opinion, for people who ultimately it's, there's that whole end of the search community too, right? Who they do the acquisition, but they actually want to operate, right? And they're not really as necessarily interested in maybe doing all the acquisition. It's like they do the acquisition and then they kind of never do it again necessarily. Right. And so I think for somebody like that, like, why not, right? Like if you can get the right opportunity and the right economics, like it could work out for both sides. So definitely think there's a world where that could work. Okay.
So we're in 22, you've got the 2 ABA businesses, you've got your original home health business, which is now 4 acquisitions large. What happens?
So I would say 23 was a pretty transformative year for us in that, everything we'd kind of done at that point set us up well for what was really a pretty transformative acquisition that we did in the middle of 23. So there was actually a very similar and adjacent service line that we entered into organically already in our home health business that provides in-home care for individuals with developmental disabilities. So very, very similar to the home health. It's just it's a client who has a just different kind of diagnoses and different types of needs. And it's not a nurse; it's a caregiver, who's actually there. Again, we kind of expanded into it organically. Made a lot of sense. It was a lot of our payers actually also. They reimburse that service as well, similar referral network. And we'd actually gotten, sometimes I think the best strategy is actually sometimes if your customer is asking you for something, right? Maybe think about maybe giving it to them. And so we'd actually, oftentimes get calls from our referral partners and be like, oh, like, do you guys also do, IDD home care? And we at the time didn't, and thought, okay, like this makes a ton of sense. Again, it's in-home, we're recruiting, we're providing top level, care and customer service. So we went into that organically. And in 23, there was an opportunity to acquire a business that does just that service line that actually was a bit bigger than we were at the time. So it was a little bit of, we were the minnow and they were the whale. It wasn't that much of an extreme difference, but they were substantially bigger than us at the time. And, I think the only reason why we were able to pull off that transaction was, in some ways, they might have had more clients, more revenue than we did at the time, but we actually had. If you were to walk into our offices, like I think we had the platform built, if that makes sense.
Yeah.
And so, we were able to do that acquisition and ultimately absorb that business into ours and gain, a service line that we were already trying to get into and already were in organically that we really liked and, was a key component of what we did, and added actually just a lot of synergies across the whole organization. And two, I think we had a little bit of the internal know-how to take this business, which needed the same kind of integration and systems placement that, we had been doing on a smaller scale, done as well. So I think, we were in a rare position. And by the way, they were also in Southern California. So it was kind of a perfect fit. And we were, fortunate enough to work with those sellers to, get that transaction done. And, they were great partners in it. They're still involved, not involved. They're still invested a bit in the kind of combined business. And that's really kind of what was transformative and, put our business together in what it is today. So, what we ended up doing actually as part of this was we ended up actually combining the ABA business into the larger platform, because all three of these segments actually are super complementary, we realized. And so we, at this point, are a diversified, kind of one-stop shop for in-home care for young adults, children. Most of our services are all focused on young adults, children, and frankly, non-geriatric clients. So, at this point, that's what we do, which is we can take care of individuals with physical disabilities, developmental disabilities, and then also provide, therapy as well. So it was that when I say it was transformative, right? We combined we did an acquisition and combined all three into one business here.
So I said Holdco at the beginning. It's really not. It really is a single business.
We haven't talked about it, but we do own another healthcare business that we haven't touched on. Is completely separate, but at one point, yes. I mean, this business though was combined into one. We also own it's a vascular access business that's called VictaPick. They work with hospitals and other facilities to place picks and midlines, which kind of like IVs that go into they're heavy duty IVs that go into your arm and are used for infusion and stuff like that. So we do have that asset, but yes, I mean, at one point we went from, I guess, having what we thought was going to be 4 individual companies to merging 3 of the 4.
And when you merged the 3 of the 4, what was the end result of the employees, numbers? What numbers can you share about the size there? You doubled the business. If they were bigger than you more than doubled it.
Yeah, we more than doubled it. And, at the time of closing, I'll use round numbers, but, we were at that point combined, we were doing about 100 and $1 million of revenue. We had about 3,000 employees, 3,000 plus employees at that point. And about 3,000, clients, right, that we were taking care of every day.
Were you at this point surprised at at the rate at which you'd moved? I mean, in 5 years, you said that transformational acquisition was actually in 23. So you'd only been at this 4 years at the time, or 4 years from your first acquisition. This, to me and listeners, will feel like a tremendous amount of progress. Some of my guests will kind of, their North Star or their final goal will be $100 million in revenue at some point in the future. You guys got there in 4 years. So react to your own speed.
I mean, I got a lot of gray hairs in my beard, I guess, from it, but no, it was, it was, yeah, I wouldn't say it was expected. That wasn't necessarily how we mapped it out, but, I think we just kind of were always heads down and worked at it. And when opportunities came up, we just jumped at them. Right. And I think there's a mix of, being out there and hard work, but also, a little bit of just being in the right place at the right time. Right. And
Sure.
I think for us, I kind of talk about 23 in that I think the core of it was building a good platform business, whether it was the $6 million of revenue, initially, right? I think like we just always thought like, if we want to build big, like it needs to look like a big organization would from the beginning, because then when like when an opportunity to, really scale up occurs, like you can actually do it, right? As opposed to, looking how maybe your revenue reflects you. I mean, I remember when we use like Sage for our, accounting software. I think when we were talking to the account rep, he was like, I think you guys are the smallest revenue business we've ever signed on. Right. And I think we were just kind of always I think we asked him for a discount because of it. So that was I'm joking, but, but, I think we just always wanted to kind of make sure that we were positioned for what we ultimately kind of thought we'd want to be. And yeah, we got there definitely faster than I think we planned, but yeah.
Well, it's yet another example in your story of how you spent that first year going slow to go fast ended up being so valuable. You really, that foundation was really something you could plug a lot into and it would hold.
Yeah, for sure.
You are now not operating. You were operating this whole time. You were in there as the operators. When was the decision to step out, or how would you characterize what the change there?
Yeah, I think around. I don't think actually initially. I think our plan was always to at some point take a step back, because frankly, I think we do want to invest across a couple different assets, and I think one thing we learned early on when we owned a couple of these different businesses were, you really need to show 100% dedication, or somebody needs to be 100% fully dedicated to each business and the operations, right? Otherwise, you're kind of going to we were either do acquisitions kind of at 50% or operate at 50%. We were lucky that we were two people. So we obviously had, and that was part of the reason, it made sense, I think, to have that partnership in the first place, was we knew we were going to both operate and acquire. But it got to the point where I think we realized, what, we want to do some other investing and some other roll-ups and some other acquisitions. We need to go out and actually find some people and some individuals who can 100% dedicate themselves to what this business needs. And, as part of, when we essentially got that Transformative deal under contract, I think at that point we realized, okay, like we're at a scale now where we really should go out and put together a top-notch management team. And so as part of that deal, essentially, we kind of kicked off that process. And, I think it's the smartest thing we've ever done. I think we were decent operators, but, I think the team we have in place now is frankly better. And it's the best decision we've ever made, which is putting the people that are in there in place and frankly, trusting them to run the business. They were seasoned industry, vets in the space. And, I think to date, we still work very actively with them, but I mean, they're doing a great job. And, again, I think it was the right move for us. So we removed ourselves about 6 months after that, after that deal. So early 24 was kind of when we started to step away. And at this point, we've kind of transitioned to looking for kind of new opportunities.
I just did another interview this morning for the Minds Capital podcast with an independent sponsor who talks about how half the time he makes a leadership hire into one of his portfolio companies, it just doesn't work out. And they apply all of the frameworks, best practice, hiring best practices. Still, the hit rate is only about 50%. How did you get so fortunate that the management you put in seems to be working out so well on your first try, hiring at that level?
I think in this case, the way that we found the right individual was, first of all, they did have industry experience. So, they were kind of a known commodity, that they understood how the space worked. And frankly, I think, they were local too. So we met a lot of time. This was not a, 2-interview process to place this one. And I think there was no question that this person knew how to run a business of this scale, how to operate in this industry. And, I think more importantly, what they showed was just, good cultural fit with the existing organization. And ultimately, I think just had the drive and the eagerness to go and do it. And so, look, maybe it was a little bit of luck too, but I think we definitely chose right. Why? I think that's why. I think we just kind of hopefully we had the right setup and process, but we definitely made a good choice on that one.
And it's so funny, Michael, the three things that you just identified, not systematically, but they jump out at me because the interview this morning was the same three for his story of placing a CEO that just did wonders, which was culture fit. It's, kind of obvious, but your leadership has to fit within the existing culture of the organization, your chosen leader. Deep industry expertise, so already knows the industry, can hit the ground running. But and then the third is just the eagerness. This person was characterized as a born salesperson. I don't know if you'd say the same of yours, but somebody who's just hungry to get after it as well and grow the business and sees the opportunity, sinks their teeth into the opportunity to take a business to the next level.
Yeah, for sure. I mean, I think, we've always had a little bit of the ethos, like, because when we started, we'd do it too, which is, we want somebody who's willing to do everything. Not that they should, right? But like anything that needs to get done at the company, like nothing's beneath the CEO if it needs to get done, right? And I think that's kind of what we wanted. Not that the CEO should be spending their time doing a lot of stuff, but we want somebody who kind of is just, part of the team. And because I think you got to lead from the front these days, frankly. And I think, the ivory tower office CEO was just not the right, that wasn't what we were looking for. And we got exactly somebody who's just eager and just willing to go to the next step. So
Great, Michael. And in your decision to make this change, why did you decide against selling, which you certainly would have considered? Why not just sell and exit and take that and go into something else?
Yeah, look, I think we still have a lot of room to run. I mean, I think, one thing I actually always didn't fully, I understand, but I kind of didn't fully understand from my private equity life was you spend all this time identifying a good company, you build it out, you grow it, and it's going really well. And in some ways, you got to crystallize at some point, and funds have, fund lives, but you sell your best assets. And I think in a world today, it's actually kind of hard to get good assets. Our view is, I think let's hold on to it until we stop compounding effectively. Right. And when that happens, then maybe we aren't the right owners. But for now, I think, at that point, we just thought, hey, we're hitting on all cylinders. We have a great team coming on board. Let's continue to invest behind this because we believe in it. It's a great company and love what it does. And we'd like to see it, go from double again. Doubling.
Yeah. And you were in a financial position where you could go off and start buy a new platform without needing to exit.
I mean, look, we have a great set of investors who have backed us. And I think even though we haven't, at this point, we have a great set of investors who have backed us. And so, we're doing it obviously, as much as Pine Street can contribute like we do to all of our deals, but, we have a great set of backers now at this point who I think want us to execute on a similar strategy or, similar investing, theses, but, somewhere in a new space.
But were these investors with you for the SBA deal? No.
So a lot of them were, actually.
Oh, okay.
A lot of them were from the original set.
Oh, okay. So in fact, you wanted to maximize the SBA loan, as we talked about, so that you could maximize your equity in the business. But in fact, you still needed to bring in investors into that deal.
We brought on a good set of investors when the larger deal in 23 that we did. We brought in a new set of LPs as well, who've been also fantastic from the get-go. And I think it's been so far a pretty good result, and I think people are excited to continue to invest. So we're getting toward the end here, but just to give me my headline for this episode. Just kidding, not kidding. What? Give us the revenue that you started at and where you are today, please, of the whole portfolio. Yeah, so we started at $6 million of revenue, and now the whole portfolio is going to be doing about 140.
So when I said 20x I was actually understating it.
Maybe. Yeah.
Yeah. That's great. And now we're in 2025. So this is now basically after 6 years. Remarkable.
Yeah.
Great. Okay, Michael, wrapping up here, was there any topic that we didn't get to that you want to make sure that we hit?
Yeah. I think one thing I would add was, I think a lot of searchers oftentimes think whether the partner or not. And I think, in my case, I would say, I'm a big proponent of having, a partner. I mean, I got very lucky that I partnered up with, a good friend for a long time, but also what ended up being a great partnership. Right. And I think, I wouldn't say just do it to do it, but I think, if there's a rationale to, which for us was we felt like we could carry twice the load if there was two of us and, block and tackle, and also to have, a good sounding board and just that partner in the business with you. Like I'm all for it. I actually think it was a huge accelerant to this. And, I know I'm on this, but he's, equally as much a part of this as much as I was. And so I would tell, everybody in the audience, like, pick carefully, but I think if you can if you're lucky enough to pick a good partner, I think it's as good a decision as you can make.
Mm-hmm. Great. Well said. And just another thing, Michael, on the choice of ETA as a career, I mean, you're kind of, at the risk of making you uncomfortable, you're kind of an exemplar. You guys have moved very quickly, sort of the phrase of choice of the episode. 6 years, over $100 million. So a lot of people may be inspired to go down this path, are inspired to go down this path by stories like yours. Of course, there's a lot of hardship along the way, but are you as enthusiastic a proponent of this career as I would presume you are? Is this a pretty great way to spend a career? Do searchers reach out to you? Do you know others who are earlier in their journey and you're pretty enthusiastic that they proceed?
Yeah, I mean, the short answer is yes. I mean, look, I think if this is something that is right for you as a person who is thinking about this, and you have that itch, and you want to go and kind of be your own boss, or just kind of go build something. I mean, I think it's the best thing I've ever done. And it's just been both, the ups. There are definitely downs, by the way. Like, I know we kind of probably focus on more of the ups on this on this podcast, but trust me, there were definitely days where it was not all up, and there were days where we thought, oh my God, like, what are we doing? But overall, like, I mean, it's been an amazing experience. And I think I would recommend it for anybody who but you really want it. And I think if you do, like, I think there's nothing better.
Fantastic. Well, let's leave it on that note. Michael Davidov, if people want to reach out, we'll put links to your LinkedIn. Name of the firm, we heard it once, but say it again.
It's called the Pine Street Group. The
Pine Street Group. Great. And if people want to reach out, they can grab you on LinkedIn or
would love that.
Okay. Super.
Definitely always open to talking to people who are trying to, do something in the space.
Excellent. Michael, thank you for coming on and sharing your story. We really appreciate it.
Thanks, Will.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode with an introduction to the interview, a link to the video version on YouTube, and soon, key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.